Today, folks, it is the end of August, Friday the 29th, finishing up one heck of an earnings week, driving our portfolios to continual all-time highs in this epic bull run as we break down and offer full transparency into my TFSA, my RRSP as a Canadian that invests abroad to see what these markets are doing for my accounts, as I've done from day one on this channel. But before we do, we got to broad view the markets, see what is actually going on the back of a pivotal earnings week. So if you're on a path to financial independence, if one day you want to retire early, you want to join a community and myself on that journey, go hit that subscribe button, folks, because man, oh man, the big bets we've been making are starting to pay off. Google being the leading Mag 7 stock this week, up 4.5%, is something incredible. But we've seen Nvidia earnings where I think we're starting to get buyers exhaustion. I mean, Nvidia's earnings were absolutely awesome, but the stock is up so much. It's like a $4.5 trillion company. And the only thing that I think is holding it back is Trump opening up free trade. I think free trade should be globalized. Hey, if you don't want tariffs across the board, why can't we sell chips to China? Could you imagine how much more money Nvidia could be making if they could just sell free trade around the world right now? In fact, we've seen Alibaba post earnings today and announce they're producing their own AI chips, which is helping drive the stock. And we'll talk about how good China's doing in the latter half of this video. But that's kind of what I've been paying attention to in the US markets, because Meta, Microsoft, some mute trades going on there, but Google's still remaining my favorite gem that I'm holding. And we'll talk about that more in a sec, because the Canadian markets in tandem in a similar fashion, mega cap leading the way this week with earnings from Royal Bank. Many of the Canadian banks, Royal Bank's up 5%, Bank of Nova Scotia's up 8.6%, Canadian Imperial almost 4%. The only one lagging is TD, and that is because TD's already gone on a massive 30+% run this year. However, you got to pay attention to commodities when you're talking about Canada right now. Commodities, I think, of what have kept us out of this crazy recession on the back of lower immigration, tariff wars, and what was supposed to be an economic calamity is actually one of the best bull runs we've experienced in history, and gold continues to hit all-time highs. And I told you, buy the gold companies, because for as long as gold continues to rally, the earnings, they're going to be great. The margins are going to continue to expand. This is a very peculiar market for the commodities sector. And when it comes to valuations, and I know this is a continual concern, and I've told you, you can't really trade off, valuations, because these can stay elevated for a long time without a black swan or something causing a correctional event. We've continued to get through just absolutely mind-blowing earnings that help keep these valuations elevated. And honestly, the market could run another 20, 30, 40% before a 20 or 30% correction. You don't know when those times come. So don't try and predict the future. Don't just go to cash or do this or that, because nobody knows what's happening tomorrow, guys. Just keep an emergency fund, a stock market emergency fund, and cost average as normal, because man, it is working to our favor. And a lot of this shows in speculative markets when it comes to margin as well, right? Like, I mean, when bull markets truly take effect, the valuations get stretched because people just get comfortable spending money. And though you might not be comfortable investing, I'm telling you right now, whoo, baby, margins over $1 trillion for the first time, guys. And I can't wait to see what the August numbers look like, because something tells me they're superiorly higher with the comfort on the back of earnings and the reports that we've seen. And the other side of it too, for you cash stackers, it's like both ends of it. I mean, there's record levels of capital, almost 7.4 trillion sitting in money market funds. I can't wait for the next quarterly updates here as well, because something tells me even higher. So we've got people stacking record levels of cash. Something tells me a lot of that's Warren Buffett's money as well. And then we've also got speculators that love trading into margin, and who knows, it's such a peculiar time we live in. And you could make a case for both sides right now. But regardless, the greed is still pretty strong on the fear and greed index. So driving this down into what's happened in my portfolio, being a relative conservative investor, a growth investor, I think this is a healthy portfolio for somebody that's my age at 33. I'm not looking at covered call ETFs. I'm not just dividend focused, but I'm not just growth focused either. However, I have centered my portfolio around technology with a hint of Canadian stocks and a little bit of global market. And as time goes on, I will become more of a global market investor. But again, where I'm at, I'm still looking to get to my goals and using growth, and especially in this incredible bull market, to get me there. And honestly, the only thing I really bought this week was VDY. I couldn't help myself on the back of where we started to see earnings. I was like, man, I got to buy a bit more VDY. And sure enough, I'm still up on that position this week, because Royal Bank really helped propel VDY, being that monthly paying Canadian dividend ETF. But I am buying it mostly for broader exposure. But recently, it's been a better grower than the S&P 500. If we actually take a look at the comparable performance of these stocks that I hold, I am just blown away to see every single position I have is outperforming the S&P 500, and the S&P is just barely up 10%, comparably VDY, discluding the insane dividend that's around 4% that I have on it. I mean, it's up 12%. Alphabet's up 12% now on the year. Meta's up 26%. XEQT's up over 10% and still offers a higher yield than VOO. So all of these have been really doing a great job at helping me beat the indices. So when I look at the performance of my accounts, I'm shocked to say that, yeah, we're still able to outperform the S&P 500, implementing a very simple strategy of cost averaging into the many and focusing on the few, really picking a few drivers to not overcomplicate investing, with VDY and VOO being the primary positions in my tax-free savings account. I never thought VDY would outpace VOO. I'm kind of blown away by that, and hopefully it continues because it's nice getting the yield off of it as well that I'm able to reinvest. But Google being the primary growth factor, now up 21%. It is crazy to watch how fast Google's return has been. And with the upcoming court case for the monopolistic fine, if they have to sever part of the business or not, time will tell. But I think once we're past that, if we can post one more good earnings period where we're getting great growth behind search, I wouldn't be surprised if Google finally actualizes a fair price to earnings multiple of somewhere between 25 and 30, and the stock is trading somewhere closer to 250 to 300. Within this account, the average buy being 174. That would lead us getting up to hopefully closer to 40-50% returns before I cut the position in half. As mentioned, this is a pure trade. I think it's a bit speculative for me to be making an individual stock 10% of my portfolio, but I do plan on, cutting that in half and then going long the rest of the shares, at which I'll take that capital and continue to divide it between probably these two ETFs, or I'm still looking at like global market ETFs, perhaps like VT. But nonetheless, the performance in this account, I'm very excited to see. As we come into the end of August, I will update you guys when the total returns update, which is something that I wish covered call investors, dividend investors alike, and growth investors across the Finfluencer Clown spectrum here on YouTube would show, because I really think we should start normalizing total returns as a benchmark for how you're doing over a 3, 5, 10-year period, instead of over analyzing short-term periods based on income, weekly or monthly income, or, just short-term fluctuations in growth stocks. As much as I like giving you weekly updates, the reality is I'm not basing the actual performance of my accounts on a weekly return. So here is what I'm showing you as a benchmark with my TFSA that's been around since June of 2017, up 258% against the S&P, up 162%. And thanks to the Google rally, thanks to VDY, we should continue to excel past the S&P 500, or at least that's the hope. In my RRSP, this is the most boring account, but I like it this way because I'm looking for more or less average returns at this point, because I've done so well on the back of speculating in the past. And again, I'm trying to move toward the phase of wealth preservation as I've finally met my FIRE goals, guys. I'm knocking on the door in the next 1 or 2 years of paying the mortgage off and getting my accounts to a level that would supplement our income need be, where we could pull 4 or 5% off without actually, hindering to the long-term growth rates of the accounts. And yeah, I'd prefer to do this. And honestly, looking at XEQT that has been outperforming the S&P, I'm speculating there's a chance that could continue to go on with the back of, the Canadian market's doing so well, the China market's starting to pick up. The valuations are a bit more lower in some of these other markets, but, we'll see if a correctional period comes or if the U.S. can sustain higher values for longer periods of time. But still, I'm concentrating the S&P, and that's how it'll remain. The S&P is a long-term vehicle for me and a retirement vehicle for me, so I don't really care as much about short-term valuations regardless. But still, if we take a look, one of the biggest decisions that I did make in my RRSP was selling off SCHD when I used to be more dividend focused. As a guy who thought I would be pulling dividends out of this account and I wanted access to them at a drop of a dime, I've obviously pivoted from that strategy. And some of you have been pointing out, even though SCHD has been lagging the market, I've called it an interest rate recovery plan. We just haven't got interest rate cuts. And some of you have been pointing out that VDY has been a better performer because we've had interest rate cuts here in Canada. So it will be neat to see, because VDY comparably has done better than XEQT VOO, not only in volatility, but in return. So it's going to be neat to see if SCHD can make up the lackluster difference over the last 6 months, really lagging the rest of the indices if interest rates cuts become more material in the future, right? But my RSP, as mentioned, has been my best performing account purely thanks to Tesla, up 319%. I'm hoping when we get the numbers coming into the end of August here that we are actually trading at all-time highs for total return, but still, I made that mistake getting into SCHD when I should have kept focusing on more total return investments, because man, this account could have been up 400 or 500% if we just stuck to S&P and a few growth stocks like we have. But again, I'm slowly alleviating away from that strategy of concentrated growth investments. But regardless, today, Friday, again, I think we're starting to see buyers exhaustion. Even though earnings have been great, there's been a lot of buying. We've been in an up into the right market perpetually for quite some time now, since the bottom of April. So it's no surprise we're getting correctional periods. Yes, it sucks seeing Meta drop. Meta has been doing quite well for us, but again, I'm not really concerned. I think Meta tends to trade between a 23 to 30 times multiple pretty typically, and we're kind of right in between that range right now. Crazy to see Nvidia's correction after those absolutely mind-blowing earnings, and the real numbers, as far as I can tell, seem to be coming out of some of the more dividend-oriented stocks. So VDY is probably doing pretty okay today, and China is starting to get some pretty good returns thanks to earnings that are coming out of the mega caps like BABA popping off here. We'll see if we can start retesting the yearly highs, but up 57%. This has been a hard one for investors because, when you look at the returns just sitting to where the IPO date is, this is why most people start pivoting toward, index funds, because as a basket, you should be sitting at all-time highs. But if you've been buying this at any time in the last several years, you've been feeling the pain. But again, when you're buying individual stocks, the time at which you buy them matters, I think, more than cost averaging, because you're playing a different game when you're playing individual companies. And, when you take a look at the earnings now and the share buybacks, Alibaba's checking a lot of boxes. They're still growing. They're buying a crazy amount of shares back. Thanks to the recent earnings, the numbers have been getting quite absurd, actually. If you take a look, their earnings per share here have been up 80%. Quite astonishing. 31 cents. The revenue growth has been kind of slow, which surprises me a bit, but you have to imagine this company, I think, does 2 or 3 times, maybe more than that, of the shipment volume than Amazon. BABA, in the perspective of operations, is bigger than Amazon, but their revenue growth rates aren't nearly as comparable, right? Because they've been mostly growing at a 2-3% clip year over year, which isn't great, but they have been able to actualize some pretty absurd earnings off that revenue. So with share buybacks, earnings growth, we should be in a new growth phase for Alibaba, presuming there's no geopolitical tensions that continue to arise and we kind of go back to a more modest, neutral market when it comes to that news. So time will tell here. I'd love to know if you're buying the Chinese stocks, and if you have been within the last year or two, congrats, because you've been seeing outsized returns. But otherwise, I'm going to sit here with my Meta position that we've been buying at great dips. Every time we've bought in Meta, it's been mainly on major dips, and same with Google, right? Like, we were really buying in these lower periods. So hopefully that equates to outsized returns. Hopefully we can take some profits, continue diversifying in the coming months. But I'm always long-term minded, guys. I don't tend to do short-term trades. And even when I am, they're still pretty lengthy, 6 to 12 months. I'm always trying to look into the future, because it doesn't matter what the valuation on a company is, like Nvidia, if the future growth potential is there and you can recognize that it's coming and you understand it well enough, that is a value trade, regardless of if it's trading at a 30, 50, 100 times multiple. If you understand the business and that business model has some massive expansion ahead of it that you can foresee, that is the value, right? That future value you understand is what we're trying to actualize on here. So in totality, we're doing pretty good, guys. I never thought I would be here at this point in my investing journey, and I'm sure many of you are saying the same thing, that just stuck to that true and tried method of cost averaging over longer periods of time and not getting caught up in short-term fluctuations in income. And the results speak for themselves. But I will pass the question off to you. I love to know how you're doing this week, where you think the market's going, and anything else that you love about this market in that comment section. But as always, I'll catch you in the next one.